Welcome to this week's edition of Wall Street Lingo. What I want to talk about today is short sellers. You know, there's been a lot said about short sellers lately, especially in Europe. They want to ban short sellers, especially in the financial sector in Europe. But you know, the fact is, short selling plays a critical part to this market. Now, what is short selling? Well, short selling is selling things you don't own, in this case, equities that you don't own. Now, I know that sounds counterintuitive to anything you've heard, because how can you sell something you don't own, you say? Well, when you short sell an equity, you're doing that in anticipation of buying it back at a lower price. So like buying a stock, hoping it goes up in value, when you short a stock, you're hoping it goes down in value so you can buy it back at a lower price. This is done on what we call plus tick, so you can't force a stock down by just selling. You have to wait till the stock sells on a plus tick before you can get off what they call a short sale. But again, short selling is very healthy for the market because eventually short sellers must, by definition, become buyers. They have to eventually cover their position, so they have to buy it back. Very healthy for the market. So in the long run, short sellers are very good for the market, and they're just very good for the market. Well, thank you for joining us on this week's edition of Wall Street Lingo.